Hello everyone, this is Sandeep Kulkarni. We're going to start a new series called Market Outlook from this month onwards, where I'm going to put together data from various points. I'll try and make sense of that data for you. Okay, let's start the market outlook for this month, September. For the last 9 years, since 2015, everybody has been waiting for that corporate capex cycle to start, and it has been elusive for us. It's been every year we thought that this year it's going to start and it's not come through for some other reason. Now, for the last 2 years, we are seeing signs that the corporate capex cycle is about to revive. And this year, it is expected that the corporate capex cycle is going to be about almost 8 lakh crores, which is much higher than what it has been for the last 8-10 years. So that's quite healthy and quite good news for us. And this we've been waiting for this kind of news for so many years. Power sector is at the forefront of the capex cycle. Almost 14 lakh crores of capex is expected from in power sector in this year. In the next 3 years, rather, defense is the next one where almost 2 lakh crores of capex is expected in next 2 years. Cement, semiconductors, Jal Jeevan, steel industry, data centers, mining, oil and gas, these are the sectors where high amount of capex is expected. Amongst the companies which are at the forefront of the capex cycle, Reliance, ONGC, Bharti Airtel, Indian Oil Corporation, NTPC, Adani Enterprises, Grasim Cement, Tata Steel, these are at the forefront of it. And out of the 8 lakh crores, almost 3.5 lakh crores is coming from the top 10-12 corporate companies. This is another interesting data point that I want to talk about. If you look at the bank credit growth, it was quite subdued for quite some time, for almost the entire previous decade. It started to pick up in since 2020 when it has been continuously going up, but it has suddenly collapsed in last couple of months. Why? What is the reason? We want to understand that. A lot of bankers are blaming mutual fund companies that they're channelizing their savings away from banks, and it's getting invested in equity markets. But that is far from truth. What is actually happening is that even if money is going to mutual companies anyway are going to invest the same money with the banks. They're going to park the money with the banks. It's not going to be parked somewhere else, right? So the argument that money is flowing to mutual funds and which is why banks are not getting deposits, it's not correct. So what is the reason? Why are not banks struggling for raising deposits? Why is the credit growth slowing down? So probably the prime reason why credit growth is slowing down is because RBI has moderated money supply, and it's a discretionary move by RBI, which is having an impact on loan to deposit ratio. This move by RBI is limiting the bank's ability to expand their balance sheet while lending aggressively against their deposits. So that is the problem. That is the real problem. Besides this, there are two other problems. One is that banks are competing with each other for raising deposits. Because of the shortage of deposits, they are competing with each other to raise more and more deposits. So even if RBI is able to cut rates in next few quarters, it's doubtful what kind of deposit rate cuts banks will be able to undertake because of the competition which is there in the market. So that is so if they are not able to cut deposit rates, but they have to cut lending rates, then the margins will get squeezed and the profitability is going to get hit. Another third big concern which is coming off recently is that RBI has come up with the liquidity guidelines. If they are implemented, I think banks' profitability is going to be hit quite substantially, and the markets are not factoring that in. So that is what is ailing banks. I want to point out one snippet from Mr. Ramdev Agarwal's interview where he said that if deposit growths are growing at 12%, you cannot have a 8% economic growth. So it is important that bank credit growth is good to ensure that economy is growing at 8%. Now this is one of the most interesting slides of the presentation that I want to talk about. Here we want to compare the profit pool, sector-wise profit pool of financial year 19 with profit pool of financial year 24. We'll ignore all the other columns. Okay, we'll just look at these two columns: profit financial year, PAT for financial year 19 and PAT for financial year 24. In financial year 19, Nifty 500 companies had a profit pool of 5 lakh crores. If you look at what has happened in the last financial year 24, profit pool has jumped almost 3x to 14 lakh crores. Of the 9 lakh crore delta, almost 5 lakh crore has come only through banks, where the profitability is improved from 65 lakh crores to 65,000 crores to 5 lakh crores. So almost 5 lakh crore delta has come only from banks. Another 90,000 has come through automobile sector, where profit after tax has jumped from 7,700 crores to 96,000 crores. And third biggest contributor to delta has been oil and gas, where the profit has jumped from 1,35,000 crores to 2,74,000 crores. So a delta of almost 1.4 lakh crores. So between these two, almost out of that 9 lakh crores, 7 lakh crore delta is coming only from these three sectors, which is banking, financial services, automobiles, auto components, and third is oil and gas companies. companies. So these three are contributed maximum to the overall delta. Now the moot question is, if everybody knows that markets are slaves of earning, if the market has to double from here in next 5 years, this 14 lakh crores profit pool has to grow to 28 lakh crores. Now tell me, which of the profit pool is going to double? Who's going to contribute to that delta of 14 lakh crores? Which group has the ability to contribute to that delta of 14 lakh crores? As of now, it's looking very difficult for me to imagine that the 14 lakh crore profit pool is actually going to become 28 lakh crores in another 5 years. It's looking like the banks are going to what appreciation or whatever growth we've seen in the last 5 years in banks has been because of the normalization of the profit as the NPA cycle has bottomed out, and they also record a lot of NPAs in the last few years, which is again added to the bottom line. Same thing cannot continue. In the next few years, we'll see hyper competitiveness. Credit growth is slow. So how can banks' profitability improve significantly from these levels? That is another problem. Then can you depend on oil and gas to generate big delta? It's a very cyclical sector, so you can't be sure what kind of profit pool we'll see for oil and gas companies in next 5 years. Similarly, third biggest profit pool is IT sector company. Usually IT sector companies have grown in single digits. There have been hardly a couple of years here and there where it has grown more than 10%. So even if there's a 50% delta from this, we are talking about only 50,000 crores. If these big profit pools are not going to double or triple, who's going to contribute to that 14 lakh crore delta? That is the big question that I have in my mind, and that is what makes me a little skeptical about these markets. Let's look at what has happened in the last 10 years. There are two components to market return. One is profit growth, which is otherwise also known as EPS growth, and second is something called as P re-rating or P ratio, P de-rating. If you look at what has happened in the last few years, a lot of growth for Nifty 500, for example, in the last 10 years, the earning growth or profit growth has been barely 10%, but price has compounded at 14.5%. The additional 5% difference which is there, that has been on account of expansion in the PE multiples. Similarly, for mid cap also, the profit growth has been barely 12%, but price CAGR has been almost 18.8%. So the PE multiple expansion has contributed to 7% of that at 18.5% kind of return. So what I'm trying to say here is that now the question is whether this kind of re-rating can continue, because we are already trading at unprecedented valuation. Now imagine what happens if the valuation de-rate in next 5 to 10 years. Then what kind of returns are you going to expect? You will not even get the returns that your portfolio or the market returns will be even lower than what is the profit growth which is going to happen. So that is another concern that I have. Probably even if the profit growth is 12%, there's a chance that index does not grow even by 12%. So that is something that we need to be cognizant about. This is one chart which was put out by Marcellus Investment Managers. This is something called as CAPE ratio, cyclically adjusted PE ratio. Currently, the cyclically adjusted PE ratio for Nifty 500 has now exceeded the valuation that it had in 2007 peak. So it is unprecedented valuation that we are witnessing in the market right now. And Nifty valuation are still slightly more reasonable. So large cap is still reasonable, but the broader market is now at unprecedented valuations, even more expensive than what it was in December of 2007. And this is another look at the CAPE ratios, percentiles of various countries. We look at it, India is trading at 98.2 percentile. What does it mean? It means that in the history, 98% of the time it has traded at cheaper valuation than what it is currently trading. So these kind of valuations are not sustainable. Rarely has this kind of valuation sustained. So probably there's a very high chance that the PE multiples that we see get derated in the next few years. On the other hand, if you look at markets like emerging markets, particularly China, Brazil, Mexico and South Africa, Poland, there the valuations look quite cheap compared to their own history. So what next? What should we expect from going forward from here? See, even if the valuations are at like 2008, this is not 2008. I'm not calling for Armageddon. I don't think we're going to have 50, 60, 70% kind of a correction in the market. In 2008, what happened was economic cycle, credit cycle, capex cycle, market cycle, all topped out together. Today, only market valuations are expensive, but economic cycle is probably early to mid stage. Capex cycle is in early stage, and credit cycle is also probably early to mid stage. So there's a long way to go. Just from economic point of view, there's a long way to go. I think the previous capex cycle lasted almost 8 years, and this year, like, we are just about to get started. The previous capex cycle started in 2004 and it lasted up to 2012. Here we are just about to get started. So another couple of years, at least 5 to 10 years, we should see the next capex cycle. Another thing that we need to understand is that big capex usually is followed by, first you get, after a big capex, right, first you get high depreciation and high interest cost, which eat into your profit pool, or which eats into your profit growth. So in the next 1-2 years, the profit growth is going to be below expectation, in my opinion. After the capacities are commissioned, once the capex happens and after the capacities are commissioned, the sales growth starts to pick up. In next 2-3 years, I think the market outlook is going to be hazy, because I think the P is also going to get derated, and even the earning expectations which are there are not going to be met. So, but the outlook for next 5 to 10 years is fantastic, because I said ki capex cycle is just about starting. Once the capacities get commissioned, the profitability improves quite substantially over next couple of years time. So in my opinion, this kind of a situation, doing SIP is the best strategy, as you will be accumulating. As market, I expect the market will be volatile and you will get opportunities to accumulate mutual fund units at lower NAV over next 2-3 years. And once the valuations come down, and then there will be one big year, maybe it's 3rd year, 4th year, 5th year, whatever, I don't know which one, where then the market will get re-rated completely and we'll see substantial appreciation to the portfolio. I think that's the best case scenario. So I think SIP is the best route in this market. There will be no loss of emissional capital. You don't have to spend time looking at the market. You don't have to get frustrated that the market is not going anywhere. It will be I think it will be a little difficult to do trading in this market, because I feel a lot of breakouts will fail, supports will break down, promoter will show their true colors. So I think next 2-3 years it will be a difficult market to navigate for a lot of traders. I think it'll draw on a lot of their emotional capital. It is going to be a fantastic period for SIP investors. So that is what I feel about the market. Let me know what you think about it. You let me know what are your views about the market in the comment section. Thank you.